Alarm.com share price has dropped by a whopping 18.9% since the recent tech sell-off. So is this a good time to buy? In this video, I will analyze what they do, what are their potential, as well as take a look at the financials to see the kind of returns that we as investors can expect. Now the company overview talks about a cloud-based operating system enabling subscribers to manage their properties with highly advanced IoT technology solutions. In essence, this means they allow users to control all their smart home devices through a single source. These include things like CCTV security cameras, electronic locks, smart lights, and energy-saving utilities. However, it is noted that majority of their total addressable market is concerned about security, and it is the number one reason why they will use smart home electronics. So while the other devices are good add-on, investors should be clear that the demand is for security systems integration. So since 2012 till 2020, their subscribers have grown at a compounded annual growth rate of 29%. This is a huge growth rate, and if put into context, it means their number of subscribers is doubling every 32 months. Over the years, we can see that their capabilities increasing from starting with integrated doorbell cameras to acquiring video analytics capabilities. So my take here is that their focus is shifting towards the commercial side, as there is not much need for analytics within an individual home. Instead, think about the potential solution video analytics can solve on company premises. So just to rattle two off my head, with video analytics, companies are better able to understand customers' shopping profile as well as their movement in shops. Using this data, they are better able to push promotional products and drive sales. Employers are also able to use such capabilities to optimize lunch breaks and stagger workers for crowd control. In today's COVID situation, where social distancing is of utmost importance, this could be a potential catalyst for Alarm. So if we look at the current market, we can see that Alarm takes up about 24% of all professionally monitored security services. If we assume 80% of the total addressable market will be using these integrated home management services, that is still a whopping 19 million more customers Alarm can reach out to. So this is an addition of more than double their current subscribers. Out of their 4 key investment highlights, I believe that the SaaS recurring revenue model is what investors should be most excited over. I would say that there are 2 engines that will stabilize this ship. Firstly, it is the stickiness of their product. Once a homeowner uses their product, he is unlikely to switch out due to the difficulty in reconfiguring every other single device. Next, a recurring revenue model ensures a consistent and predictable income source for the company, reducing any future fluctuations in earnings. Now if we look at what Amazon has been doing, it is clear they are trying to optimize their delivery packaging system. And in order to integrate the doorbell, security locks, and camera, as well as within the home smart devices, who do you think is best positioned in this regard? So back in August last year, Alarm shares fell after Google invested $450 million in ADT, Alarm's competitor. Google's ultimate aim was to integrate ADT into the Google Nest platform. However, because of my above argument, I don't see it as a cause of concern. The market is big enough for both players because of their different agenda. So before we start on the financials, I would like to point out that the numbers are in USD millions. So right off the bat, we can see both revenue and net income increasing year over year steadily. However, I would like to point out that the net income has been growing much faster than the revenue. This is because their operating expense, which grew 2%, has not been growing as fast as their revenue of 19%, which result in margin improvements. So next, if we look at the cash flow from operations, which is the true cold hard cash generated from the day-to-day business, we can also see a similar trend over the past 5 years. However, I noticed an irregularity that in the year 2019, CFO dropped compared to 2018. So from the annual report, it was stated that the CFO actually dropped due to a settlement of a class action lawsuit of $28 million for using automated telemarketing calls to promote Alarm.com's goods and services. So I would have to say this makes me somewhat uncomfortable on the way they do business, and I would definitely need to investigate further before making any investments. Next up I will do is to take the difference between the CFO and the capital expenditure to get the free cash flow. So this is the leftover cash a company is able to use for dividends, buybacks, or whatever else they want to do with. So this is a very healthy free cash flow statement. So the shares outstanding are also not any cause for concern as well, having a pretty slow growth rate of 2% annually. So in the event the shares increase quickly, investors should be cautious. It could be potentially dilutive to their existing holdings. However, I don't see any cause for concern here. So with both the free cash flow per share and the price per share, I'm able to get a free cash flow yield of around 1.7%. So I will use this number in the later calculations to get the share price in the next 5 years. So I will be much more conservative over here. So I'm going to assume only a 20% growth rate and declining by a percentage point every year. So this results in a free cash flow per share of $3.77 in the year 2025. So with the previous calculated value of 1.7%, I am able to get a estimated stock price in 2029 of $218.49. So this means that if we purchase the shares today at $87.24 and get a stream of cash flows over the years, we are able to exit and sell our shares in 2025 at $219. This results in an internal rate of return of around 29%. So in layman term, this means you get 2.7 times of what you put in after 5 years. So now to reiterate, I will not be making any investments for now, as I would like to dig deeper into the business model and previous lawsuit. So please do your own due diligence before investing in any stock. Thank you so much for watching the video, and if you like what you see, do subscribe and like to help me reach more viewers.